Hello and welcome. I am Smita Kaushik, Assistant Professor Management, Jagannath University, Jaipur. And today I am going to give an overview on the subject financial accounting. First of all, I would like to introduce the term accounting. Accounting is the systematic presentation of economic activities of business for end users. Now I would like to explain the term users of accounting information. The accounting process provides financial data for a broad range of individuals whose objectives is studying the data very widely. Users can be divided into two parts, that are internal users and external users. Internal users are owners and managers involved in the day-to-day operations of the business and in long-term strategic planning. External users of accounting information fall into 5 groups. Each has different interest in the companies. These groups are prospective and current board members and investors, creditors and lenders, employees and their unions, customers and general public. Accounting can be classified into three branches, that is the financial accounting, cost accounting and management accounting. First branch of accounting is financial accounting. Financial accounting is an art of identifying, classifying, recording, summarizing and interpreting business transactions of financial nature for end users. Accounting is the means of measuring and reporting the results of the economic activities. Second branch is cost accounting, which is the branch of accounting which deals with the cost of production and its various constituents. It is concerned with the classification, allocation, recording, summarizing and reporting current and the prospective cost. This is the final branch, that is the management accounting. Management accounting is a system of assemble and furnish the useful material and the summarized accounting information to the management. Management accounting is the effective blending of financial and cost accounting together with the financial management. These are some of the attributes of the financial accounting. Very first is the accounting is an art as well as science. Accounting records only those events, that transactions which are of financial nature. Accounting records transactions by expressing them in terms of money. These are some of the objectives of the financial accounting. It helps in maintaining proper records of business transactions. It helps to calculate profit or loss at the end of every financial year. It helps in depicting true financial position at the end of the year. It provides effective control over the business. It also helps in making information available to the various users. Now this is the process of the accounting. Very first step in the process of accounting is identification of the true economic event, then classification of the business transaction, then recording the business transaction, which can be done by the means of journal entries, then the summarizing the business transactions, in which we do a ledger posting and making trial balance. Next one is the analyzing and interpreting the business transactions by making financial statements. And the last one is the communication to the end users. These are some of the advantages of the accounting. It helps in replacing memory. It helps in assisting the performance of the business. It helps in assisting the financial statement of the business. It provides documentary evidences for journal entries. It assists in realization of the debt. It helps in facilitating the sales of the business. It helps in preventing and detecting frauds. It is helpful for the management and decision making. These are some of the limitations of accounting. That is, it provides incomplete and inexact information. It shows some of the valueless assets. It does not help in preventing frauds and manipulations. It ignores about the present value of the business. Now we will discuss about the term bookkeeping. Bookkeeping may be defined as the science and art of identifying and recording accounting transactions systematically in the proper books of accounts. It is not concerned with disclosing or interpreting the results to the business. Now we will discuss about the source document, or we can say vouchers. A document which becomes the basis for recording a transaction in the books of the accounts is called source document. These documents shows the nature and amount of the transaction and named vouchers. In accounting, every journal entry must be supported by the source document, popularly known as vouchers. These are some of the source document which we need in accounting, that are cash memos, invoices and bills, receipts, cash in slips, checks, debit notes and credit notes. Now, journalizing transaction. The word journal has been derived from the word jour, meaning daily records. Journal is a book of primary record for the small firms, and for big concern it is prepared in the form of cash books, purchase books, sales books and other subsidiary books in the addition to journal proper. Now we will discuss about the classification of accounts. Classification can be done on the basis of modern approach as well as traditional approach. According to modern approach, accounts are classified into 5 groups. Very first is assets. It includes accounts of properties such as land and building, plant and machinery, furniture, patents, invoices, etc. And the rule for assets which you use for journalizing transactions are debit increase in assets and credit decrease in assets. Second group is liability. It includes accounts of lenders, creditors of goods, creditors of expenses, etc. And the rule of journal entries for the liabilities is debit decrease in liability and credit increase in liability. Now the capital or we can say equity. It refers to the accounts of the proprietor or partners who invested money in the business. Debit decrease in capital, credit increase in capital. Now the fourth group is revenue. These are the accounts of incomes and gains. Examples are sales, interest received, commission received, rent received, etc. And the rule is debit decrease in revenue and credit increase in revenue. And the last group according to the modern approach is expenses. These accounts which shows the amount spent or even loss in carrying on business operations. Examples are purchase, wages, depreciation, rent, etc. And the rule for generalizing transaction is debit increase in expenses and credit decrease in expenses. Now, according to the traditional approach, accounts may be classified into 3 groups. Very first is real accounts, accounts of all the assets except debtors. And the rule is debit what comes in and credit what goes out. The second account is nominal accounts, accounts of all the expenses, income, losses and gains. And the rule is debit all expenses and losses, credit all incomes and gains. This one is the third, that is personal account. Accounts of all the persons, maybe natural, artificial or representative, comes under this head. It includes the accounts of companies or firms, etc. And the rule for debit and credit is debit the receiver, credit the giver. Now we will discuss about the subsidiary books, or we can say subdivision of journal. It includes cash book. Cash book is used to record receipts and the payments of cash, including receipts into and out of the bank. Second one is the purchase book. It is used to record credit purchases of goods. Next is sales book. It is used to record the credit sales of the goods dealt in by the firm. Purchase return books. It is used to record the returns of the goods and previously purchased on credit. Next is sales return books. It is used to record the returns of the credit sales made by customer. Then bills receivable books to record the receipts of promissory notes and other parties. Bills payable book to record the issues of the promissory note to other parties. And the last one is the journal proper. It is used to record the transaction which cannot be recorded in any of the 7 books mentioned above. Now this is the next step in the process of accounting, that is the ledger posting. Collection of requisite information concerning a particular account and presenting them under one head is known as the ledger posting. Usually the transactions are first journalized and then on the basis of the journal it is recorded in ledger. After ledger posting, we'll usually prepare trial balance. A trial balance is a statement prepared with the debit and the credit balances of the ledger accounts to test the arithmetical accuracy of the books. Trial balance is the list of debit and credit balances taken out from the ledger. It also includes the balances of cash and bank taken from the cash book. These are some of the objectives of the trial balance. It helps to ascertain the arithmetical accuracy of the ledger accounts. It helps in preparation of the financial statement. It provides summary of each ledger account. It helps in locating errors. These are 2 methods which can be used for preparing trial balance. That is the balance method or the totals method. Balance method, in this method only the debt or credit balance of ledger accounts are entered separately in the 2 columns of the trial balance. And in totals method, the total of each side of the ledger accounts is entered respectively in the debit and the credit columns of the trial balance. Now accounting for depreciation. The term depreciation refers to the accounting method used to allocate the cost of the tangible or physical assets over its useful life. Depreciation represents how much of an asset value being used. These are 2 methods which can be used for accounting of the depreciation, which are straight line method and diminishing balance method. Now the last step in the preparation of the financial accounting is preparation of financial statement. Preparation of financial statement is one of the last step in the accounting cycle using information of the trial balance to develop the current financial statement. Preparation of financial statement includes preparation of profit and loss account or income statement. The income statement calculates the net profit or loss which are determined by the sales revenue, expenses and the general ledger records. Next one is the preparation of the balance sheet or the position statement. The balance sheet illustrates the company's financial position. It is a snapshot of the last day of the accounting cycle. Concluding my session, I would like to say that financial accounting is the framework that sets the rules on how financial statements are prepared. These are the guidelines dictate how company transacts its operations into series of widely accepted and standardized financial reports. Financial accounting plays a critical part in keeping companies responsible for their performance and transparent regarding their operations. Thank you.